while all those about you are losing theirs. You can't control the way the world works, but you can control the way that you react to it. It's important too, Jake, even though the world faces a lot of threats, to maintain a sense of optimism. A sense of pessimism, when you are surrounded by the volatility that we're surrounded with, causes you to coil up and do nothing. And doing nothing is precisely the wrong result. So understand, first of all, that you aren't going to understand it perfectly. Understand that just because it ends poorly for many doesn't mean it needs to end poorly for you. Our mutual friend, Doug Casey, called his first newsletter Crisis Investing, after the Chinese parable that the Chinese sign for crisis and the Chinese sign for opportunity were in fact the same. What one must do is maintain agility, maintain confidence, maintain even aggression in a circumstance where doing nothing simply is not an option. We have lots of, how would you say, colliding forces. The deleveraging of the Fed balance sheet, quantitative tightening, taking money out of circulation. At the same time that we have negative real interest rates. So a very deflationary action in very inflationary times. Add on top of that, incredible public sector debt with popular demands for more government spending. In other words, the voters seem to be asking us, despite the fact that we're deep in a hole, to dig more. So there's all kinds of things out there, and I think the best that one can do is prepare one's own self to deal with the circumstances that come to them. One example, Jake, and I'm sorry for this long-winded answer. One example is to look at a pattern of falling prices around assets that one wants to own as a good thing, not a bad thing. We've talked before about the fact that declining prices, in fact, a bear market, is financial speak for a sale. And sales are good things. Many of us don't like the fact that some of the goods that we already have in our inventory are declining in price. It isn't merely the price of opportunity that's falling, it's the price of inventory that's falling too. But I suspect, Jake, that if your listeners develop a sense for why they made their investments, which is to say, if they begin to make their investments based on value rather than narrative or momentum, that they will have the confidence to not just stay the course, but increase their exposure to sectors that make sense. And they will come out of this liquidity crisis, that we're going to have a crisis in confidence. I believe, I hope I'm wrong, that the system has both too much confidence and too much debt in it. If interest rates were to be normalized, Jake, they would have to go to a positive real yield. Given that the underlying rate of inflation is 9%, a positive real yield would imply a 10% 10-year treasury, which would imply federal, state, and local governments paying a third of their current income by way of interest without having very much money left over for the services that citizens demand. Traditionally, the 30-year mortgage rate is traded in front of the 10-year treasury, which would suggest a first-year mortgage rate, a 30-year fixed mortgage rate with some number like 10.5 or 11. If you think real estate prices have fallen a little bit in the last little while, think about what an 11% 30-year fixed rate would do. Now, I'm not one of these who believes that we're at the end of the world, that there's going to be widespread breadlines. I am of the belief that it is more likely than not certain, but rather more likely than not, that certain categories, and I don't know what they are necessarily in the credit market, I suspect personally that they're going to be corporate junk debt, but that doesn't matter, are going to be faced with the specter of much larger than anticipated defaults. And when the default cycle begins, a few things happen. The investment banks and the commercial banks, when they understand the damage that's been done to their portfolio, assume that the same damage has been done to counterparty's portfolio, and money seizes up, liquidity goes away. And when liquidity goes away, confidence goes away. Will it be a replay of 2008? I don't know. But my suspicion is that one needs to orient their portfolios and orient their minds in anticipation of the probability that we face a liquidity and confidence squeeze. Let's say that you're careful for 2 years and nothing happens. What have you really lost? Not much, except for 1.5 or 2 years worth of opportunity. Let's say, by contrast, that you continue to speculate in crypto products that you don't understand, in technology stocks, in penny mining stocks, in over-leveraged real estate. Let's say that you play the game really, really, really aggressively, and we have a replay of 2008, and you lose 90%. My suspicion is that at least the middle course, which is to say that people only invest in things they understand and maintain more liquidity than they otherwise would, years, but not a lifetime. I can afford to be more aggressive. But despite the fact that I can afford to be more aggressive, I'm very, very, very liquid. I'm actually more liquid than I would like to be. I'd like to be more exposed to risk. But understand that my exposing myself to more risks comes in the context of being old and fat and rich. And it also comes in the context of being very experienced in times of turmoil. I survived barely the collapse of the commodities boom in the late 70s. I survived the October 19th, 87 crash in much better condition. I survived the tech wreck. I survived 2008. I survived 2010. I'm psychologically and financially able not just to ride through this circumstance, but actually take advantage of it. You too, at your young age, as a consequence of the success of your own business, have the financial resources that if you exercise discipline with regards to how much money you allocate to speculation and continue to invest in your own business, bringing utility to the customers, you'll get through this well, almost no matter what. The people I'm concerned about, Jake, are the people whose skill level and customer base is marginal. Those subscribers that you have that are in highly contestable jobs, where they might lose their job in an economic slowdown. Those people who are struggling to pay their consumer debt and their mortgage simultaneously, that may, as a consequence of losing their investment cushion or losing their job, lose their house. It isn't you or I that I'm concerned about. We will come through this with some new scars, but likely we will come through it absolutely better off, and compared to our competitors, decidedly better off. But many of your subscribers, Jake, are not in the circumstance that we are. Those subscribers need to build large cash cushions, particularly those subscribers who are in contestable jobs, jobs that could be exported, jobs with companies that are marginally profitable. Those people need really to be concerned about their ability to maintain their living standard. Some real estate assets that I'd held for a very long time. And I continued to hold them during a period of declining interest rates, because I saw as interest rates declined that the capitalization rate around those assets increased. When I saw a circumstance about 2 years ago where I didn't believe interest rates could go any lower, I thought that as a non-professional real estate investor, that I had taken the best part of the cycle, and I decided to sell that portfolio. Similarly, I relocated from the state of California to the state of Washington. So I had a couple of other assets that were California domiciled. And I believed and continue to believe that at least for the near term, the golden age of California is past. And so I sold those assets. The consequence of those economy, and they're very confident with regards to their own business, which means that successful business people know how to navigate multiple economic conditions. What that means is that most people add value in their business better than they add value in their investments. And they also have a psychological profile to endure risk and be nimble in their business where they don't in their portfolio. So for everyone whom I have ever met that is a successful entrepreneur, the best place for them to focus their efforts and their capital is on their business. When you get to the point where I got, a little older than you are now, where your business is generating more surplus cash than you can feasibly redeploy in it, then you begin to invest. And when you have invested enough that you have, in an off-color sense, your FU money, you begin to speculate. I would suggest that an investor is a person who deploys capital on the probability of earning a reasonable return on capital employed. A speculator is somebody who can afford to take real risks in return for outsized returns. And I think that the asset allocation matrix goes very much like that. In the beginning of your career, stay liquid so that you can take some risks with your business. Put your effort and your cash into your business until your business is generating surplus returns. When the business is generating surplus returns, depending on your psychological tolerance for risk, invest and or speculate with the surplus capital, Jake. And I hope your viewers don't take this too seriously. Almost everything I just told you to do, I didn't do. I started off speculating aggressively. And the consequence of that is that after being a very wealthy young man, I ended up having a negative net worth. A hard lesson. I have made much more money investing than I have building businesses. But the truth is, I've made a lot of money at both.
Yeah. Okay.
For most people, what I hope they can do is avoid some of the scars that I gathered early in my career by taking risks that were inappropriate for at least who and where I was financially. For many people, Jake, starting a business, operating their own business, isn't the highest and best use of their talent for whatever reason. And you can certainly make yourself materially wealthy and a happy person working in someone else's business. What is important to understand is what task that generates value for other people do you enjoy doing so much that you're thinking about it when you wake up in the morning and you're thinking about it when you go to bed at night? If you are competing with a wage slave, if you are competing with somebody who works 8 hours a day, punches the clock and goes home and tries to drink themselves into a stupor so they forget about the day they just had, and you love the task so much that even when you aren't at work, you're thinking about it, you're going to outcompete that person. You're going to outcompete him in the first year, but the second year, you're going to outcompete him compounded. And by the fifth year, if you're thinking about what you're doing 15 hours a day and your competitor is drudgingly doing it 8 hours a day, you're going to be so far ahead of them that it's going to take them a telescope to see you. So identify a task where you deliver value for others and you're interested in and enjoy the process. The second step, and this came to me at age 30, this is going to sound really strange. Don't worry about making money. Worry about generating utility for your customer. If you worry about generating utility for your customer, the money will come in and of itself. So as an example, if you're designing a self-help product, don't worry overly about any aspect other than servicing the customer's need with a course that is the very best you can do and substantially better than the course offered up by your nearest competitor. When you do that, as you did, the thing that appealed to me when you came into my office in Carlsbad as that young, gentle hippie 5 years ago was the passion with which you described your self-help business, how good it felt to help people turn their lives around. You didn't tell me how much money you made. You didn't tell me what kind of car you drove. You didn't tell me about your desire for a home in Rancho Santa Fe. What you told me about was how you were involved in the process of learning how to teach other people to make their lives better. It was precisely that passion that told me, you know, if this young guy can take that passion for self-help and teach his generation more about finance, he's got a hell of a career ahead of him.